Welcome to my YouTube channel. My name is Ryan Banks and my channel is about financial tips and tricks that you can bank on. And I post videos every second Monday at 5 p.m. Eastern. So investing can be a topic very overwhelming because you don't even know where to start. Well, today you're in luck because I'm going to be going over the key information you need to know to start investing. And I'll also be going over why you should start investing early in your life. Now, the first question you might be asking yourself is, well, when should I start investing? Well, anyone at any point can start investing in their lives, but I only suggest if you have additional cash from your day-to-day expenses. So this means you're not living paycheck to paycheck. So when you do have that extra bit of surplus every month to put towards investments, I would suggest for you to make financial objectives. And what I mean about financial objectives is you want to make a plan to what you want to invest towards. So this could be multiple of things. This could be a down payment for a house, a down payment for a car. If you want to go on a big vacation with your family, this can mean saving towards retirement. Or if you're a high school student, this can mean saving towards your college or university fund. But anything is possible if you plan for it. Now that you have that extra bit of cash and you're ready to invest, well, the second thing you should do is know the level of risk you're willing to take. So this means if you want to go into a more safer or more riskier investment. So a safe investment is like a GIC, for example, where it's a fixed high interest account where you know exactly how much you're going to get at the end of the term. But if you want to go more risky, you could buy an individual stock, for example, and the performance of your investment is solely based off how that one company does. But you can also meet in the middle for medium risk investment where you can go into a mutual fund where it's a pool of companies. So usually it's formed of 30 plus companies, and the performance of your investment is based off of all those companies in that pool. So even with those descriptions, if you're still unsure of the level of risk you're willing to take, here's a good rule of thumb. If you're going to need your investment in the next 6 to 12 months in the more short term, then I would suggest for you to go into a more safe investment. But if you need it in a more long term, so let's say 5+ years, then I would suggest you to go more medium to high risk investment. So for example, if I'm gonna need a down payment for a house in the next 6 months, I'm gonna go invest more towards a GIC or a high interest account. But if I'm gonna have that down payment needed in 3 to 5 years, then I'm gonna suggest to go more in towards a medium to high risk investment. But even with that, at the end of the day, it's what you're most comfortable with, because at the end of the day, it's your money on the line and you don't want anyone telling you what to invest or what specific stock or portfolio that you should go into. So you should always feel comfortable what you invest in. So now you know exactly what you're investing towards and the level of risk you're willing to take. So now the next biggest question is, well, what specific stock, mutual fund, or GIC should I invest in? Well, the biggest tip I can give you is to do your research. If you do your research, you know exactly what you're getting yourself into. So a good example of research is looking at the history of the company, looking at some graphs, looking and reading some articles, and even reading some of the financial statements to see if they're financially stable. So once you do your research, you're going to have a good indication where the stock is at that current point in time. So the next obvious piece of advice is buy low, sell high. So with that research, you should know exactly where it's trading at. But I'm going to give you a quick example here, and I think it's relevant at this point in time. So if I'm looking to go into a GIC, well, right now we just heard that interest rates went up by 0.5%, and they're going to continue to go up based off of what the Bank of Canada has said. So right now, if I want to invest into a GIC, I'm going to choose to go more short-term GIC because I know interest rates are going to go up in the future, which means more return for me. And the second piece of research I'm going to be going to do is looking at all the different banks, all the different credit unions and other institutions to see what interest rate they're going to give me when I go into the GIC. And obviously, I'm going to pick the highest one. So by doing my research, I'm going to be maximizing the amount of money that I can make. The next thing I want to talk to you about today are broker fees or investment fees. So these vary depending on the institution or program that you use. So If you use a broker for your investments, these fees range between 1% to 2% usually. And if you use a self-directed account, which is a Wealthsimple or Questrade, for example, these fees can vary between 0.1% to 0.2%. Yes, these fees are way lower, but you do all the work yourself. So I'm going to give you this piece of advice. If you're the type of investor who looks at their investment or the market every single day, then I would suggest for you to go more towards a self-directed account. But if you look at your statements every quarter or every year, then I would suggest for you to go towards a broker. And if you are going to go with a broker, I would suggest for you to go see 2 or 3 different brokers before investing and see what they have to say and see what they suggest for you to invest your money towards. So this way, you're going to feel more comfortable investing your money with that broker. And the next piece of advice I want to give you about investments in general is to stay diversified. Diversified means you're invested into a different level of risks and or different sectors of the market. So for example, if I am invested into solely one sector and that sector is not doing so good at this point in time, then my investment will most likely go down. But if I'm invested into 5 or 6 different sectors, then that one sector who's doing not as good will be offsetted by the other 5 that are going up, which means I'm more likely for my investment to go up over time if I'm diversified. Now I want to go a little bit more detail into low risk investments and more specifically savings accounts with your bank, for example. So usually you only get a maximum of like 0.2% return, and that's probably very fair of a return if you get that much. And the reason why I don't think those savings accounts are that good is when I compare that 0.2% compared to inflation, you're losing money over time. So for the people who don't know what inflation is, it's the average price of a commodity increases every year, and that rate usually increases by 1% to 2% every year on a normal year. Since we're coming out of COVID and the way the market is right now, inflation is over 5%, which is really high. But for the example I'm going to be giving you right now, let's just say it's a normal year and inflation is 1.5%. And I do get that 0.2% return on that savings account. So technically, I'm losing 1.3% return every year. So this isn't a really good investment. But if I would go more towards a medium risk investment, which averages 5 to 7% a year, I'm making money over time, which means my net wealth is increasing over time. So now the last thing I want to go over with you today is why you should invest early. And a term that you may have heard is called compound interest. So what compound interest is if I invest $100 today and I make 10% by the end of the year, my total investment value will go up to $110. And if I continue investing that the following year, I still get that 10% return. My total investment value will go up to $121. But if I waited a whole year to invest, I would only have $110 in my investment. So because I waited, I got $11 less. Yes, this is a small amount, but if you spread that across 30 to 40 years and you're investing towards your retirement, that compound interest will help you grow your wealth way quicker. And you can have a great safety net by the time that you retire. So to put this in a different perspective, Kevin O'Leary said if you invest $100 a week in your 20s, by the time that you retire, you will become a millionaire. Did you hear that correctly? A millionaire. So by investing early, you can plan for your future retirement and have a great safety net. Now to wrap up the video, if you're going to take a few things out of this video, you want to start investing early in your life. And when you do invest, you want to do your research. And you can make anything happen if you plan for it. So another thing I want to just touch upon quickly is if you're thinking of opening up a Wealthsimple account, I've added a referral code in the description of this video that you can click on, and we can both get 2 cash value of random stocks from Wealthsimple to help you get started. So if you have any questions about the video, you can definitely post a comment or send me an email at ryanbankscpa@gmail.com. So thank you very much for listening, and I hope everyone has a great day.